Powering modern AI requires a physical footprint so large and energy intensive, it's forcing the world's oldest software companies to rewrite their financial playbooks. Oracle recently released its fiscal year 2026 third quarter earnings. The headline numbers were exceptionally strong. GAAP earnings per share jumped 24%, and total revenue climbed 22%. For a legacy enterprise tech company, this was a massive acceleration, marking Oracle's best quarter for organic growth in over 15 years. Yet, in the exact same report, management announced an urgent need to borrow cash, outlining a plan to raise up to $50 billion in new debt and equity financing. This table tracks Oracle's trailing four-quarter free cash flow, the cash left over after operations and capital expenses. Over the past 12 months, free cash flow has plunged into a severe deficit, landing at negative $24.7 billion. Oracle is reporting record profitability on paper, but that top-line success is masking a capital-intensive physical restructuring of its business model. Historically, Oracle operated with the financial profile of a traditional software vendor. They wrote code once, sold global subscriptions, and enjoyed high margins with low physical overhead. The generative AI boom makes that low overhead model impossible. To capture market share today, legacy tech giants have to physically construct heavy industrial-scale compute facilities. Moving earth, pouring concrete, and securing gigawatts of electricity translates directly into massive liabilities on the balance sheet. To accurately value Oracle today, we have to look past the software margins. We must deconstruct how customer prepayments, a $500 billion backlog, and historic capital expenditures are re-architecting the company. To understand why Oracle is taking on this debt, we first need to isolate exactly which part of their business is actually growing. This is Oracle's supplemental analysis of GAAP revenues. If we look at their traditional divisions, the growth is sluggish. The legacy software segment grew by just 3% in Q3, and services grew by 12%. That stagnation disappears when you look at cloud infrastructure. This segment is experiencing accelerating momentum, culminating in an 84% growth rate this quarter. In raw dollars, that growth compounds rapidly: $3.34 billion in Q1, $4.07 billion in Q2, and nearly $4.9 billion by Q3. Management noted in the earnings release that market demand for AI training and inferencing capacity is vastly outstripping the actual supply of available servers. This demand for raw computing power is the gravitational force pulling Oracle out of its software lane, forcing it to become a heavy infrastructure provider. The scale of that future demand is quantified in the most significant leading indicator of the entire report: $553 billion in remaining performance obligations. Remaining performance obligations, or RPO, is a metric that represents contracted, legally binding future revenue. The customer has signed the deal, but the company hasn't recognized the money on its income statement yet because the service hasn't been delivered. Oracle claims this 325% surge is driven by large-scale AI contracts operating on a unique mechanical structure. Instead of Oracle buying servers and hoping clients rent them, the clients are signing massive contracts up front and supplying the cash or the actual GPUs directly. This customer-funded prepayment mechanism effectively de-risks the most volatile part of the AI boom. Oracle doesn't have to drain its own internal funds to acquire expensive, rapidly depreciating graphics processing units. But while the clients are financing the costly GPUs, the physical burden of building the data centers to house, power, and cool those chips falls entirely on Oracle's balance sheet. That $500 billion backlog represents theoretical future revenue, but building facilities to deliver on those contracts requires navigating a brutal reality on the cash flow statement. This table bridges that gap. The top line tracks GAAP operating cash flow. It shows that Oracle's core business is healthy, consistently generating cash, and ending Q3 with $23.5 billion in positive flow. But generating that cash is only half the equation. The other half is capital expenditures, or Capex, the hard cash spent to acquire physical assets like land, concrete, cooling systems, and power grids. Over the trailing 4 quarters, Oracle's Capex has escalated significantly. It grew from a $27 billion deduction in Q1 to a $48.2 billion cash drain by Q3. Plotting these metrics against each other, the visual math is stark. Physical data center construction costs completely devour the cash generated by Oracle's software sales. The net result is the negative $24.7 billion trailing four-quarter free cash flow we saw earlier. Management guidance confirms this is not a one-off anomaly. They expect the spending pace to continue, locking in $50 billion in total Capex for the upcoming fiscal year. The infrastructure requirements of generative AI have temporarily transformed Oracle's cash flow profile, replacing their historical surplus with a multi-billion-dollar deficit. If a company is burning through $24 billion more than it generates, how does it keep the lights on and continue building out facilities? Looking at their condensed statement of cash flows, the answer is aggressive leverage. Oracle is bridging this infrastructure gap by taking on immense debt, securing over $44.5 billion from senior notes and other borrowings in the first 9 months of the fiscal year. They formalized the strategy in February, quickly securing $30 billion through a combination of investment-grade bonds and mandatory convertible preferred stock. According to management, the order book for that debt was substantially oversubscribed. Wall Street investors looked at the $553 billion backlog and agreed to finance the construction required to fulfill it. Oracle is engineering its capital structure, leveraging the reliability of its legacy software to debt finance a historic physical expansion. The Q3 fiscal 2026 earnings report maps a permanent, structural shift in what Oracle actually does for a living. Oracle has transitioned into an AI infrastructure utility, prioritizing a $500 billion backlog over near-term cash flow. This pivot guarantees massive future revenue. The $500 billion RPO legally locks clients into Oracle's ecosystem for years to come. But securing that dominance requires abandoning the predictable cash flow profile that software investors historically demanded. The $30 billion in freshly raised debt is the necessary bridge to ensure Oracle survives the cash burn of this transition period. For analysts modeling Oracle's valuation, the defining metric is no longer SaaS margins. The new standard is capital deployment efficiency. How effectively the company can convert borrowed billions into active, revenue-generating server racks. Oracle has successfully crossed over. They have leveraged their enterprise software moat to become a foundational AI compute utility, permanently changing how the market must value their stock.